Welcome to the Chart School of Trading University, supported by Trading Intelligence LLC. In episode number 1, I will teach you how to properly use simple moving average to predict trends and improve your trading results. Simple moving average, SMA, is one of the most important indicator for stock charts. SMA can be expressed by the following equation. Here N is the number of days, C is the close price, C1 is yesterday's close price, C2 is the close price 2 days ago, and so on. As a result, today's 20 days moving average can be expressed by the following equation. And yesterday's 20 days moving average is given by the following equation. If we subtract SMA 20 from SMA 20.1, we have the following equation. Because most of terms are the same and they are crossed out from the equation. SMA 20 minus SMA 20.1 equals to C minus C20 divided by 20. In order to achieve SMA 20.1, it is only required to meet C greater than C20. Here, we define C20 as the benchmark price, BP. Benchmark price can be used to predict the moving direction of SMA. I would like to use S&P 500 ETF, SPY, as an example. Over the past few months, SPY has been in a strong uptrend. Here is the 20 days benchmark price, which is much lower than the today's close price. Therefore, there is a high probability that SMA 20 will follow the uptrend in the coming few days. However, BP 20 will go up in the next 7 trading days. If the price drops off significantly below SMA 20, it may drag SMA 20 downward. The second example is HRTX, which has been in the downtrend in the past few weeks. Today, the close price crossed above SMA 20. Although the benchmark price is above today's close price, BP 20 will in a strong downtrend in the next 2 weeks. This will inevitably reverse the trend toward upside, even if the stock stays sideways. The worst-case scenario is that the stock gap down, and then it will drag the SMA 20 downward. "20 days moving average is for short-term trend. Here, we introduce 50 days moving average for medium-term trend and 100 days moving average for long-term trend. SMA 50 have been widely used for gauging the market's sentiment, bullish for above SMA 50 and bearish for below 50 MA. Herein, the red line is SMA 20. Blue line is SMA 50. And green line is SMA 100. Correspondingly, here is 20 days benchmark price, 50 days benchmark price, and 100 days benchmark price. Since today's close price is well above BP 100, we anticipate the SMA 100 will stay in the uptrend in the next few weeks. BP 50 will fall off next week. so SMA 50 will follow the strong uptrend. Stock price is always moving around moving averages. When the price moves up too far away from the moving averages in the exuberance phase, it deems to follow by falling price. When the price moves down too far away from the moving averages in the dried up phase, it deems to bounce back. This is how the market functions. Crossover trading strategy is one of the most popular trading methods using moving averages. For example, you can sell short when 20 days moving average crosses down 50 days moving average, and buy to cover when 20 days moving average. SMA 50 crossing down SMA 100 is another good entry point for short selling. And then you buy to cover when SMA 50 cross up SMA 100. Actually, these two crossovers are also great entry point to buy SPY for long. For example, we can enter the trade from here and get out over here, and re-enter here. For this entry point, you have very extended long run. Pullback trading strategy is the other popular strategy. This strategy has high probability of success if the stock is in the strong uptrend, that is, SMA 20 is above SMA 50, and SMA 50 is above SMA 100. These are great buy locations when the price pulls back to SMA 50 and SMA 100. We can couple these pullback points with stochastics to confirm that these buy zones. In most cases, the stochastics are less than 20 in the oversold zone. Also, we can use either SMA 100 or SMA 50 as the trailing stop. To summarize, here are a few key takeaways for this video. Firstly, simple moving average can be used to predict market movement for both short-term and long-term. Secondly, simple moving average is useful for finding trending markets in bullish or bearish sentiments. Thirdly, simple moving average can smooth out price action and eliminate market noise. Number 4, we can employ simple moving average to develop trading entry and exit for crossover strategy. Number 5, simple moving average can be used to establish support and resistance levels for pullback strategy. Lastly, but not the least, we can use simple moving average for defining trailing stops and risk management. Thank you so much for watching. If you like this video, please like and subscribe to our channel.